Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. I remember back in my day when I used to be able to buy a 24 ounce of Arizona tea for 99 cents. How much is that Arizona tea now?
Still 99 cents.
Is it?
I think they refuse to go up in price, right?
That's the only thing that has combated inflation over the years.
Oh, inflation?
They've stayed strong.
That came out of nowhere. What are you talking about inflation for? What is inflation?
My goodness. Inflation, the rise of price of costs of goods and services over time.
Sounds
The rise of-
Latin.
So we're done.
That's
Good.
it. That's it.
Okay. Let me back up. This podcast, we're going to talk about inflation, a bunch of different components of inflation, the difference between CPI and PPI, what are some of the best hedges against inflation in your portfolio, what are some tools to combat inflation in the economy. We're going to get into all that today, so stay tuned.
Don't go anywhere, folks.
Oh, sorry, we don't have intro music in there? Maybe. Okay, so you told us what inflation is. Why is it such a big topic today?
Yeah, over the past roughly 20-ish years, we've had really low inflation. That's just been the type of economy that we lived in. And ever since we saw a ton happening after '08, we've really stayed in really low inflation and low interest rate environment. And we joked about it a couple of days ago, prepping for the podcast. Some of the proposals and some of the forecasting we would do with clients, we would talk about adjusting for inflation when it came to retirement planning and other such types of financial planning. And we would bring up that 3% inflation rate and say, hey, this is what we have to consider when we talk about, Medicare costs or medical costs in general, or just expenses, groceries, whatever, over retirement. And they would be like, 3%? No way, right? And then that got adjusted, I think, in the proposals down to 2% at one point. But over the past couple of years, really after COVID, we went through a period where we saw, and we'll discuss it, we saw a lot of quantitative easing from the government and from the Federal Reserve. And with that quantitative easing, spiked a huge period where we had really some higher levels of inflation. We saw Fed rates interest rates get up into the 9s. Just a couple of years ago. So this is definitely this period of time has been more abnormal than what we have seen, the prior couple decades.
You just decided to just
So go ahead.
Yeah, you know exactly what.
I threw it all in there.
Yeah. Okay, let's unpack that. All right, so that's your stance, huh, Mr. Chang? That we're at this point because of quantitative easing. Because I have a feeling my economics friend here might say otherwise.
I agree.
With him or with?
Easing, there was a lot of stuff too. Manufacturing was halted as well too. So
Okay.
Yep.
All right. Can you unpack that? Because some people believe it's not quantitative easing. You mentioned 2020, COVID.
Yeah, because for a long time with quantitative easing, we were trying to keep rates low because we actually wanted inflation, and because we wanted to stimulate the economy. And we didn't really see inflation until the pandemic. When we shut down the world, we gave out stimuluses, and then we opened the world. And when the world was flush with dollars, but our supply chains were broken. So you have a lot of cash trying to buy a lot of goods and services, and they're not quite ready. And so we had inflation, starting in 2021. And so, like Leo mentioned, from 2021 to 2022, we saw inflation go as high as 9%, and that was the highest in 40 years. And both administrations since then have been trying to battle inflation to get it down to 2 to 3%.
Remember I-bonds?
Yeah, I'm afraid these guys keep doing it. Okay, hold on. This might turn into a little bit of a debate instead. Okay, you mentioned a subjective term, right? You said lots of supplies and goods. I think some people would argue there weren't enough supplies and goods, which is what led to inflation.
correct.
Yeah. So can you talk about that a little bit?
Yeah, because it's an equation and it's a balancing act, and inflation can be caused because we don't depending on how much we have in natural resources. Inflation could be caused if, on the demand side it's very high, but you don't have enough resources. But you could also have a situation where you just don't have enough resources to create, and so you don't have enough on the supply side, and that can also cause inflation.
Some people use like natural disasters, hurricanes, wars, other disruptions to the actual natural flow of supplies and demand.
And I would even say, even if it makes political sense to go away from a trading partner politically, it might not make economic sense. So, for example, if a country's your factory, and for whatever reason you're going away from that factory because maybe they're stealing technology, there's going to be some effect economically. So
Okay. I'm not challenging you because this is my opinion. It's for the benefit of the
Hi, people.
Yeah. Okay. You said that both last two administrations have been trying to combat inflation.
yeah.
Is it administrations that combat inflation, or is it a different body? No, I mean for the right. We're going to talk about that, right?
Yeah.
So whose primary responsibility is it to combat inflation, and what tools do they utilize?
Well, the Federal Reserve has a mandate since the 70s of full employment and stable prices, and through monetary policy, they're the ones that's not manipulating, but that
You can
works
say
on
it.
Setting is what we like to say. Setting.
They're the ones that set rates to either reduce inflation or actually spur the economy on. Yeah.
Yeah. So the Feds have two things they can do. There's fiscal policy and there's monetary policy, and so they can. There's multiple tools as discussed. One being actually just giving out money into
Lowering
the
rates, right?
economy. Well, that's one. Lowering rates is one, right? And then actually providing actual cash into the economy. So one thing they do is they'll go out and buy treasury bonds. So they'll repurchase treasury bonds, and the repurchasing of those bonds will then be able to add cash flow back into the economy for whoever's holding those bonds. And so there's different things that they can do along with adjusting rates. That's the one that a lot of people focus on because of the direct impact from short-term lending. And so people see that as an immediate change, but there's other things that they can do and they'll utilize to be able to help offset it.
Yeah, without getting too far into it, because we know you're sitting on the edge of your seat because you want to know about the Fed, the history, where it's going, and its role, because you've seen a lot of headlines recently. We promise we will deliver soon. That's not this podcast, but if I could dive in a little bit, wade in a little bit, if you will.
Yeah.
In the water.
So you mentioned.
Here's Stingray boots.
So you mentioned quantitative easing.
Yeah.
So that's what you're referring to, the Fed setting short-term rates. But that's not really what they did that in 2020, but there was also another flood of M2 supply, right? That's through fiscal policy with stimulus checks.
And treasury purchases as well too.
Right, both. Yeah. That was in 2020, but the Fed has tightened
Right.
several times.
Yeah, record-setting times since then. Yeah.
Yeah. Okay. Just wanted to be clear for everybody,
Yeah.
right? So
Yeah.
okay. You feel like you want to say something. I don't know where to go with
I'm
this,
good.
but you want to say something. You got something right here. Come on.
So the way that we measure, we can get into that a little bit. The way we measure inflation, there's a couple reports that are provided. It's CPI and PPI, so we can get into the difference between those two. So CPI is Consumer Pricing Index. So what that does is that measures the actual consumer and what they're paying for the cost of goods and services. And that's done year over year, and that's calculated every single month. And so the Fed has been looking at CPI data, and we've seen that number when it comes directly from an overall inflationary aspect. We've seen that number really come down over the past couple of years. But that's a good measurement as far as domestically what we're purchasing as consumers and what the cost of that of our purchasing has been. And each industry and sector has its own data and chart specific, but that overall index measures overall spending. PPI measures is from the producer side. So that's measuring what the producer's costs are for exports. So CPI is really more for imports, and the consumer spending. PPI measures more what the manufacturers and producers are paying on their costs from a wholesale aspect. And we've seen that come down as well too. But really what we're trying to do is look at the changes in these costs and look at that over time on a monthly basis, and understanding that, hey, we'll go what we went through from an inflationary period from a producer manufacturer standpoint, and then from a consumer standpoint, we got to levels that we hadn't been in long periods of time. And so there's an issue when it comes to small businesses, because when we're in high inflation periods, typically what we see is the Fed start to raise interest rates. Why is that an issue for small business owners? Well, that directly impacts their lending, especially short-term lending. So it now costs them a lot more to borrow money to operate and run their businesses, and it becomes expensive. Obviously, their margins start to shrink and things like that. So we understand, hey, right now we're seeing inflation come down, but where is it coming down? What industries, what specific products have we seen it really come down? And understanding that over time, we're still trying to manage, that specifically and the changes in it.
Okay, so to that point, and you mentioned unemployment earlier. What is the term? I hear stagflation on TV, and that's a concern right now. Well, is it really a concern? And what is stagflation?
Yeah, stagflation is a situation where you have inflation, and the economy is also at the same time slowing down.
You have high unemployment as well. So
Yeah.
right, so it's a kind of like the three factors: high unemployment, high inflation trying to go increase, and then the economy slowing down. Right. Okay.
But why is that bad? Like, I would think inflation's bad, period. So why does stagflation have its own name?
Because I would say most economists prefer an inflationary situation where the economy is growing, because they feel more confident that they can increase rate and slow down the economy. But if you have a situation where the economy has rampant inflation, but you also don't have growth, it gets a little bit trickier in what tools you're going to use to reduce that inflation, but still grow the economy. Yeah.
What do you mean? Why is it tricky?
Because we don't really have as much experience dealing with stagflation, and at the same time you're dealing with a slowing down economy, and it's just much more difficult. And when you have inflationary situations and the economy is actually growing, it's still growing, and so people have jobs, wages are growing, and businesses can still make a profit. But in this situation, prices are going up, but the economy is slowing down, so you're losing jobs, and businesses are not making money even though prices are going up.
Is it also difficult because what the Fed does to combat inflation is increase rates, but what the Fed does when the economy is slowing down is to lower rates?
Right.
It's not very popular. It's not a popular situation or tool to use, and so that's why they have to remain independent, because what they're going to do is slow down the economy, which may not be popular politically. So,
In a normal inflationary period, they're going to raise those rates. And if we have high unemployment and we have a slowing economy, all you're doing is adding extra costs for these businesses to operate, and they're already having difficulties, operating based on what the current economic environment is. And so that tool that they would typically use to help offset the inflation would be something that would also really, really hurt these businesses as well too.
Yeah, their job is to protect the economy as a whole, right? And so they're trying to look at it from a whole standpoint, not just the current right to second, but also down the road. They want to make sure that the dollar's still worth something, and that we don't go to a devalued currency because, right, we're just printing out too much money, or we're doing things to manipulate the economy, right? We want it to actually be a free economy.
yeah, a perfect example would be, late 70s, 1980s, when the chairman of the Federal Reserve, Paul Volcker, in the 1980s, when we had double-digit inflation, it actually got up to 15% year over year. He actually decided to increase rates, and we went into a recession. And that's how we actually got out of higher inflation rates. So he had to dramatically increase rates, which is not popular. It got the economy into a recession, but it's what ultimately finally worked. It's a very tough decision.
Okay, I'm glad you said that because you mentioned the word rampant inflation earlier. You mentioned we used to do projections of 3% over like a 40-year time period. So there is some level of inflation that's normal or necessary even, or just
Yeah, I believe they try to hold it around 2 to 3. They try to keep it within that range, right? To kind of go back to James's point, right? It's to have a growing economy, right? Prices, I think you always hear contractors say, even when prices do come back down after shortages or things like that, right? They tend to stay sticky upwards, right? They might come down a little bit, but people get used to paying certain prices, so they just kind of slowly keep creeping back up.
Yeah, in that situation, businesses are making money, people are seeing their wages go up, and they can afford the goods and services that they need.
okay.
Yeah.
Wages going up. Is that also that's inflationary?
That's inflation.
Yeah.
Yeah. We like that inflation.
Yeah. Yeah. What all that means is that people now have more money to spend, right? And so, just from economic principles, you have our supply chain, if it remains the same and people have more money to now purchase the same level of supply, the cost of that supply is going to go up because the demand is going up with higher wages over time. So naturally, it's just going to cause either higher levels of production, which then that's an extra cost for the business, and then they have to increase it because their production costs are going up, or they maintain the same level of production and they raise the price of the products because there's this higher level of demand that consumers have because they now have more money in their pocket.
Okay, so this is all really good and well, and I think it's very interesting. But what does all this mean to the person listening that's trying to figure out how to reach financial goals, like putting their kids through college or managing their retirement funds? Like, how do they position their portfolio to either offset inflation, or if inflation gets too high and leads to recession, like back in the Volcker days? What are some strategies to mitigate inflation?
We always talk about emergency funds, right? Having upcoming cash needs for the short-term horizon, anything for the next 1 to 12 months or 24 months, and then really kind of evaluating their overall goals and what they're trying to accomplish. If they have a cash flow need in retirement, right? How are they going to solve for that? Whether it be through pension, Social Security, 401k, IRA withdrawals, and then kind of working backwards, right? If they need to, if they're conservative in nature, right, they might want to look at maybe locking in current rates if they think rates are going to drop, right? Trying to preserve, the higher interest rates that we have currently. If they think rates are going to go up, right, they might want to delay locking in rates today. So it's just, I think, kind of some sort of evaluation of where they're at.
Okay, but because I've always heard, all right, so to your point, right, locking in rates. If I buy a bond today that matures in 10 years from now, I'm going to get my full principal back, right? But is it still going to be able to buy that principal I get back? Is it still going to be able to buy the same goods and services?
Yeah, probably not, right? Because just if we take in that average 3% over that time frame, right?
Okay.
I think the simple answer is no, right? I think 10 years ago, my son's haircut was like $10, $11. Now it's like $30.
Yeah.
Well, I thought Arizona teas were only $1 30 years ago. I may be talking about a different beverage.
There are specific government securities that are inflation adjusted. So TIPS are Treasury inflation protected securities. So these are actually protected securities that'll adjust based on CPI adjustments and changes. So it's linked to the actual consumer pricing index, and the rate that you get on that Treasury security adjusts based on the consumer pricing index. And I-bonds as well too. Alexis brought that up earlier. That's a vehicle that adjusts with inflation as well. Specifically, it's a bond that is government issue that has an inflation adjustment tied to the yield.
All right, man. Y'all are tossing up the softball, so I'm going to just take a hack, okay? Yeah, how are those I-bonds doing today? Why are y'all laughing?
It's true.
Let everybody know. Why?
Not great, and it's because we've saw such a rapid increase in inflation, and then we've seen a rapid decline in inflation over this period of time, and so those are really set up to endure a longer, higher inflated time frame. But we've seen CPI and we've seen a lot of those numbers come back because of what I mean, there's multitude of things that have really kind of helped lower inflation. But
Yeah, you can find yourself in the higher volatility situations for the stock market in times of higher inflation. And during higher inflation, it's really crappy for conservative investors. If you're in cash and you haven't made the move to, higher, riskier assets, because the main thing is your purchasing power. And it's kind of crappy because in higher inflation areas, you need to have your dollars keep up, which means you need to take more risk. But volatility is also going up. But long term is still the key to look at what you need to accomplish.
Yeah, I think to answer your question, stocks are one of the best combats for inflation.
Man, well, we got there, huh? It only took 4 minutes. I've been watching.
I just wanted to hear them say it. I wanted to hear what they had to say first.
All right, so I'm glad you said that. Okay, all right. So let's unpack that because I think what's really interesting. I've been seeing a lot of chatter on X. This is what my feed looks like these days.
We know.
So Jerome Powell, the Fed chair, just signaled a potential rate cut next month or September for whenever. It depends where you're watching this. So he might have already cut by now. I don't know. But he signaled the rate cut. Market took off. If he's cutting rates, that means my money market might be paying less. Yes? No?
Yeah. Correct.
Okay. If I'm cutting rates, that also could be a sign that maybe economy is weakening. Okay. So where should I put my money?
Yeah, it's like picking your poison.
Okay.
Because the stock market liked it for the short term. Because meaning you're giving an injection, but by giving an injection, that means you're saying the economy needs it, so it's actually weakening, and this is why we think this is where you stay invested, because in a day-to-day situation, there's two ways to look at reducing rates. It could be looked at as a bad thing or a good thing all in one day. And so this is where you go back to the old foundation of staying invested and looking to see, has inflation affected you? I'm sure it has in some ways, but how much has it affected you? And are you still on track to actually retire and reach your goals?
All right, since we got him going, for those of you that don't know, he's got an economics degree from
great.
one of the finest institutions in the land. Hook 'em. I hope I can say all that. I'm sure it'll get edited out.
Why not?
Okay.
Beto you.
What do you say? A lot of people have said since COVID, I think it was like 3 years afterwards, that 40% of all U.S. dollars that were ever printed were printed during that 3-year period. And we didn't rehearse this, by the way, so I hope he can. But I have a feeling he's got a really good answer.
I'm in trouble.
At least a theory.
It's like there's two other people.
And people also talk about. You mentioned the U.S. dollar being devalued, maybe potentially losing its reserve currency status. People talk about, when we got off the gold standard, that's when it really went to. Yeah.
The tides changed.
Yeah, that's right. What does all that mean?
Yeah, we still got gold. So in 1971, we stopped pegging our dollars to gold, and they gave us flexibility. Monetary policy changes when we needed to, but prior to that, it was pegged to gold. But most people don't know this. The U.S. government still has the largest stockpile of gold in the world. I believe we still have 8,000 metric tons of gold, which is about $650 billion worth of gold. I don't know
Fun
what they
fact.
are, but somebody out there knows.
Had to do it. Yes. Also in my X feed. Okay.
Nicolas Cage.
Yeah, but the way I look at it, and it might be oversimplistic, is you can peg your currency to any commodity, but if your economy sucks, it's not going to matter. The U.S. at the end of the day, the U.S. dollar is still the reserve currency of the world, and in my opinion, it's still the most trusted country. And if you want to do any type of international business, you're going to do it with the U.S. dollar. And so without that trust, without that confidence backed by the economy, to me, it doesn't matter what your reserve currency is backed by. So,
Okay, so some people think gold is one of the better hedges against inflationary times. Is that so? Are you saying that that's
Actually, they're right too, because in higher inflationary situations, commodities do really well. Oil, gold, those become a lot more volatile, and they perform very well in higher inflationary situations.
Yeah. What tends to happen is though that people hold on to that through higher inflationary timeframes, and out of those timeframes they don't perform as well. So how do you know when to hold it, when not to hold it, when to get rid of it? Crystal balls?
no?
Your grok feed?
Lock in.
Well, it's better than cash, I guess, right? Gold is more likely going to outperform cash.
I don't know. I'm asking you guys.
Oh,
Did your watch tell you?
I thought Siri was giving us the answer there. Yeah, I would say, I mean, from a diversification aspect, you can look at utilizing value type equities, dividend paying value type equities during higher inflationary periods. Those are typically going to have better just overall risk adjusted performance in comparison to other equities. But diversification is going to be really key to be able to weather through these higher inflationary timeframes.
Yeah, and I would say if you're having to back your currency by a commodity, you're kind of signaling to the world that you need to. Mm-hmm. You're kind of almost trying to prove to the world that we're safe, we're strong. Luckily for the U.S., even though as our debt has gone up, we can always back it up with our economy. And so I think that's the main difference.
Yeah.
Yeah.
And we bring this up because currency devaluation could lead to inflation.
Yes.
Right. Yeah.
Yeah.
Okay.
Yeah.
Okay. So to sum all this up, a little bit of inflation is almost a given.
It's
Probably a
it's
good thing.
preferred.
Okay. It's preferred,
Yeah.
not rampant inflation or hyperinflation. Make sure you account for it in your retirement projections, or maybe not even retirement, but education. So,
That's what I was going to mention.
Yeah,
the costs, different services or different needs have different levels of inflation over time. And so we look at, when we do those retirement projections, we do utilize that 3% rule. When we look at college savings projections, that's too low.
Yeah.
We've seen costs of education go up almost double the national inflation average rate that we've utilized for other costs and goods and services. So we've used almost closer to 6% for cost of education over time. Medical costs over time as well too have higher levels of inflation than typical normal goods and services as well too. So it's really important when you're doing your planning to understand what are you planning for, and really get a good understanding as far as historically what the average level of inflation is for that specific purchase.
Yeah, I think that's a good way to sum it up. And I would also add, just stay diversified. As you heard here, there are different types of investments or asset classes that perform differently depending on inflationary times. You just don't know when those times are going to come or end. I think that pretty much sums it up, no?
Yep.
Okay.
Yep.
Well, thanks for tuning in to another episode of Our 2 Cents on Your Dollars. Please make sure to follow, like, and subscribe. Thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along, and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.